Pravit, so is the character of the market changed, do you think, in this last several months or this year that makes it less rewarding potentially to buy these dips?
I think it has. Look, when I think about what ultimately drives the market, there are three things: the fundamentals, the price of risk, and liquidity and panic. Now, I think most people would agree that U.S. fundamentals are pretty good, right? This earnings season has shown us that earnings growth continues to be strong, profit margins are strong, we all know that. Let's get to liquidity and panic. There are a lot of different ways to judge this, but liquidity and panic is an interesting one because when panic is very high, that panic can be bought, right? In other words, if panic is driving prices, well, those prices can revert quickly when panic dissipates. And you're not really seeing too much of that. So one indicator I like to look at is the VIX. And specifically, I look to look at if the VIX is too high relative to how volatile the market's actually been. Long story short, we're not seeing huge risk aversion in measures of option protection like the VIX or skew. So we're not seeing huge, I guess, risk aversion in measures of panic the same way we saw in February of earlier this year, August of 2015. Looking at technical indicators like RSI or breadth, again, those don't look very oversold compared to the end of the month. So long story short, I don't think there's a ton of panic priced into the market. Instead, what I think has happened is that the price of risk has changed. The equity risk premium has moved higher. And while that's saying that your expected returns are higher over the longer term, that may not be a buyable dip in the short term.